apologies. I forgot to press record. So again, I want to thank everyone for attending today. With us entering the end of April, I want to recognize, or it's already recognized as Financial Literacy Month, but I want to recognize all of the small businesses that are on the call today to thank you for attending and thank you for all that you do. So just a brief history, April is recognized as Financial Literacy Month, and it is a time that is dedicated to promoting the importance of understanding and managing personal finances. And basically, in today's fast-paced world, being financially literate is more crucial than ever, as it does empower individuals and small businesses to make informed decisions about budgeting, saving, investing, and planning for the future. Now, financial literacy not only helps people achieve their personal financial goals, but it also strengthens our communities and economy as a whole. And during this month, we have been encouraged everyone to engage in learning opportunities, access valuable resources, and also take proactive steps to improve your financial knowledge. Whether it's a student, a working professional, or planning for retirement, there are tools and information that is available to help to navigate your financial journey with confidence. So as we come together today to spread awareness and cultivate a culture of financial empowerment, thank you everyone for attending. So I'll go ahead and we'll get this session started. Well, I'll turn it over.
Good afternoon, everyone. My name is Elias Hernandez. I am the Associate Administrator for the Office of Veteran Business Development, and it is a pleasure to welcome you this afternoon to today's virtual event. I want to start by emphasizing, the importance of financial literacy. As stated already, April is Financial Literacy Month, and at the SBA, we are celebrating and promoting resources alongside the VA, including today's webinar. A recent presidential message stated that the foundation of American economic prosperity is a society empowered with the knowledge and tools to make informed financial decisions to achieve the American dream. This could not be truer for aspiring and existing entrepreneurs. A sound understanding of financial literacy leads to greater success for business owners. While veterans-owned businesses are less likely to report weak sales, issues with uneven cash flow, and issues with paying operating expenses, being financially literate brings various benefits to veteran entrepreneurs. Better decision-making. Financial literacy equips entrepreneurs with the skills to analyze cash flow, profit margins, and budgeting, leading to smarter business decisions. Improve risk management. Understanding financial principles help identify potential risks early and develop strategies to mitigate them. Effective resources allocation. Entrepreneurs can allocate resources more effectively, ensuring optimal use of capital, labor, and time. Access to funding. A solid grasp of finance improves credibility with investors and lenders by enabling clear communication of financial needs and projections. Sustainable growth. With financial knowledge, entrepreneurs can plan for long-term growth, avoid debt traps, and reinvest wisely in their businesses. Strong financial management is one of the biggest indicators of business success because it gives entrepreneurs control, clarity, and confidence in how their business operates and grows. Without strong financial management skills, entrepreneurs might overspend on marketing, underestimate manufacturing costs, miss a tax payment, or fail to budget for a slow sale season. Business owners with expertise in this area track and control expenses, forecast future financial needs, make strategic investments, respond to financial setbacks, and stay compliant, keeping their business not just afloat, but healthy. During this month of financial literacy, I urge you to bolster your financial knowledge through the various resources from the SBA, BA, Department of Treasury, and more. Together, we can build a stronger, financially sound, veteran-owned businesses and share this knowledge with our communities to promote economic freedom and prosperity. Thank you so much.
Thank you so much, Mr. Hernandez. Mr. Hernandez is the Associate Administrator of the Office of Veteran Business Development. Now we'll turn it over for an overview of SBA financing with Dan Pish. And I apologize, Dan, if I messed up on your last name.
No, it's okay, Melindy. So my name is Dan Pichet. I'm the Director of Trade Finance in the SBA's Office of Manufacturing and Trade. Want to thank everybody for taking time out of their day to join us. Elias, for your remarks, and then give a little bit of housekeeping in terms of what we're going to be discussing. So just a reminder, I know, Wendy, you put this in the chat, but there is a Q&A function. We'd ask anybody who has questions, specific questions that they'd like to be addressed to get those in. I will be moderating the Q&A at the end. We do have a good expert panel. We have Patty Brewer from our Office of Manufacturing and Trade. We have Vince Haworth from the SBDC, and then Craig Jordan, who's one of our lender relationship specialists out of our district offices. So just as a little bit of a starting point, I'm going to give a quick overview on SBA financing, and then really get into the discussion, because ultimately I think that's what you all came here to see. So the SBA has a variety of programs and services available. So we're going to be touching on the loan programs today. And just to put it in context, in the last fiscal year, there were close to $38 billion in loans, comprised of more than 82,000 loans and close to 2,000 participating lenders. So these loans are available from a variety of institutions, from specialty SBA lenders to community focused institutions to large and community and regional banks. So that there's a really broad diversity of lenders that offer the programs. They fall into a handful of general programs. So you'll hear me use term 7A. The 7A is our flagship guarantee program, and that was responsible for 31 of the $38 billion in loan support in the last fiscal year. We have the 504 program, which is mostly used for capital expenditures. So think building and equipment, and those we partner with some of our CDC or community development corporations, and they help facilitate that. And then we have our microloan program, which supports some smaller dollar lending through a number of our community-based institutions. So $38 billion, 82,000 loans, close to 2,000 lenders supporting those programs. We also have an equity and another loan program under our Office of Innovation and Investment, and that's another $7 billion in support, 1,100 transactions. So this is just the loan side of SBA. So the way that a small business should think about it is the SBA, when it comes to our core loan programs on the 7A side, we work with lenders to support them making a loan to the business, and we offer a guarantee. That guarantee helps to prevent, kind of insulate against loss for lender, and that in turn helps lenders offer more in terms of capital, maybe more flexible terms. And prior to I joined the SBA in 2021. I was a lender for 16 years. I ran a lending team out of South Florida. So I've been able to see the SBA programs from the lender perspective, as well as a director here at the agency. So our goal for this panel, and as the panelists get ready to come on here, is to have a conversation in sort of the arc of finance, which I would say is we're going to start with Lending 101, an overview. What is an underwriter looking for? What is an institution looking for? We're going to move into the various types of financing needs that a business can face, as well as lender readiness, what it takes to get that process going, and then we're going to conclude with SBA assistance, and that is going to be there's a variety of different ways you can engage. Ultimately, we recognize that a business engaging with a loan is a very personal experience. Your situation is different than the next person's, your market, your need. So our hope with that last part of the panel is just to give you an idea of how to access resources. Again, please use the Q&A function, because if we can't cover it live, we will follow up with you directly on your question. So leave your information. Again, we're probably not going to be able to get to every question, but we do want to also follow up on any that we can't cover live. So with that, I would like to invite the panelists on for the Q&A side. So Craig, Patty, and Vince, if you could join on camera, then we'll kick off the discussion.
Dan, I'm on, so.
Okay. All right. So maybe to get it started, if we could have each of the speakers, we'll go in the order for the first session. So Craig, then Patty, then Vince, if you could each introduce yourself, a little bit of background, and then we'll get into our first topic. So again, Craig, Patty, and Vince, if you, in that order, if you could introduce yourself. There we go.
Thanks, Dan. And it's an honor to be here. I'm Craig Jordan, Supervisory Lender Relations Specialist with the Arizona District Office. And so what I do basically is I work with the lenders that participate in our loan program. So in my market, we train them on how to originate, service, and liquidate the loan according to that guarantee that Dan was talking about, in support of mitigating risk for both the lender and then for you as the veteran and or the taxpayer. It also allows you to get the loan just a little bit easier. So that's what my primary responsibility is kind of work with the lenders that participate, teaching them how to keep that guarantee through the life of the loan.
Great. Thanks, Craig. Patty?
So hello, my name is Patty Brewer. I am with the Office of Manufacturing and Trade, and I cover the Rocky Mountain region. So if you're in Colorado, Montana, Utah, Wyoming, or Nebraska, I'm happy to help any manufacturers or exporters in the area who are looking for financing. So I can also not only assist you with financing, but I can get you in touch with subject matter experts who can help answer more detailed questions. So if you have questions about logistics or about sourcing or about more detailed training for your manufacturing operations, we can certainly get you in touch with those subject matter experts. Thank you.
Thank you, Patty.
Hello, everyone. I'm Vincent Hayworth. I'm the director of the Capital Access Center in Kansas. I'm a former banker and for 25 years, and I was an SBA lender for 8 of those years. I currently run a capital center where we work for the client, not the bank, and our whole motto is to get our clients' loan committee ready. It's an honor to be here today.
Thank you very much. So on being loan committee ready or loan approval ready, let's start at the 101 level. So I mentioned that I, like a lot of folks who work at the SBA, have worked in various sides of banking, have been around the industry. So I started my career as a loan analyst and worked my way up for about 16 years, finishing on that loan committee. So that's where I want to start, which is, what does it take to, get a transaction across the line, and a little bit of insight into the process. And, when we were getting ready for this, Craig, I think you were discussing the 5 C's of credit. So maybe that's a good starting point. So we'll go to Craig, and then Patty, if you could offer your thoughts, and back to Vince, and I'll close on some as well.
Yeah, and I wanted to pass that out because it's important, because every borrowing scenario is some derivative of these 5 C's, and the lender is going to use this as their tool to evaluate you as a borrower in your project. And some of them you're going to be real familiar with, and maybe some of them you won't. But in the interest of financial literacy, the 5 C's are character, which is your credit. That's going to be the gatekeeper. It's the first thing that lender is going to do, is pull your credit when you give them authorization, right? It's really good that you know what your score is. That can help you, especially when you're negotiating terms, interest rates, things of that nature. But just to give you a brief overview, when I said know your 5 C's and how they affect you, know what your strengths and weaknesses are. So if your credit, say, for example, is 700 plus, that's a strength. If your credit starts creeping down below and you start ending up right at the 620 mark, you're starting to end up at the bottom tier for commercial lending, and you're probably going to have a real good reason why it is that low. And sometimes there are good reasons. Then capacity. This is really just, what do your ratios look like? Can you service the debt? How are you going to pay for it? Do you have history, right? Do you have financial statements and tax returns that you can show? Are you building a business plan? How are you going to be able to reasonably show your capacity to, to repay that debt? And then the third one, which is capital, and the layman's term is down payment. How much skin in the game do you have? How much risk have you taken with your money? Because in the lending community, the more risk you take with your money, the more likely you are to fight, tooth and nail to make that, that situation occur, right? That project or that loan be paid off, because you don't want to lose either. You've got your capital at risk as well. And then there's also, post-closing liquidity. Are you taking out a loan and now you're broke? Because the lender doesn't want that to happen either. So it's both upfront, how much money do I have to put down, but then it's also post-closing liquidity as well. And so obviously a strength would be you got a lot of money down, and then you've got a lot of post-closing liquidity. A weakness would be you barely have enough to cover those things. So just understand how each one of these C's affects you. And then we move on to collateral. Collateral is just things that the business owns and things you may own personally that can be liened in the worst case scenario that the loan goes bad. So it's used to protect the loan in case it does go bad. Those assets are usually, valued at what we'll call garage sale value. So they're never really worth what you actually paid for them. But keep in mind, it is another one of those C's. So the more collateral you have, the less risk you appear to a bank. The less collateral you have, it's kind of like having a low credit score. It's a weakness. It could potentially be overcome, but it is something that you'll have to address when you're talking to your banker. And then the last one is conditions. And conditions are basically a lot of times things you can't control, but it could be the economic environment, like we're in one right now, right? With costs, with inflation. It could be your industry. It could be how much competition is located in your zip code. All of those different things are items that lenders will use to analyze what the risk profile is of this particular transaction when they are trying to, like you said, get a credit committee, ready.
Great. Thanks. Patty, maybe if you could touch on some of the different funding sources. I know I touched a little bit on the general way that the programs work, but just some of the different lenders and different types of lenders that you've worked with.
Sure. So when you start talking about funding, you want to make sure you understand that every lender has their own favorite program. Some work with the SBA 7A program, and that's the only program they will work with. Other lenders will work with a variety of SBA's programs. And then outside of SBA, there might be just conventional lending where only the lender is involved, or there might be specialty lending, say, from the U.S. Department of Agriculture, or some states have their own small business lending that they're involved with as well. Colorado has a great deal of they have a cash collateral support. The state of Montana has a special equipment financing program for manufacturers. So depending on what state you're in, there may be other sources of funding. But when you start looking at funding, you want to ask yourself first, how much do I need? So if you just need, say, $15,000, $20,000, or $35,000, that's a good micro loan. So you might go to a community development financial institution in your area, or a CDFI, and talk to one of those folks about a small micro loan, which would be something less than $50,000. Or if you need something between 50,000 and 500, you might look 500,000. You might start looking at one of the express programs with SBA. So we've got the SBA Express and the Export Express. If you are exporting, those are really nice programs, nice lending parameters. If you need something less than 500,000, if you need something up to 5 million, then you'd be looking at some of the other SBA loan programs. The 7A, the 504 program is a great program to help you purchase fixed assets, equipment, and real estate. Or there's the international trade loan. So that also benefits exporters. So depending on how much you need, there's going to be a different program to help you in that lending category. So all of these are SBA programs, from micro lending up to the large 7A loans. But you just want to start looking at your own self-assessment, figure out how much you think you're going to need.
Great, thanks. And Vince, if you could maybe touch on kind of the connection between personal credit and the early stage of access to capital.
Sure, you bet. First of all, I'd like to point out, Craig, I've got my 5 C's of credit written down here on the whiteboard because that you're absolutely correct about. That's how the lender is going to look at every deal. So if you're at home, listen to this, do a self-assessment on the 5 C's of credit. And he had touched on personal credit, and I can't tell you how often I'll talk to a client that come in and, the bankers want to know first thing, what is your personal credit score? Because how they see it is they equate the ability to handle personal credit as a gateway to business credit. So now right or wrong is how they look at it, but the bankers look at it and say, if you can't handle your personal credit, how are you going to handle your business credit? And I think that's when we come in, that'll be one of the very first things that we ask. And unfortunately, they'll say, well, I have a good credit score. Okay, well, what's good? Okay, well, I don't know. I used to be at 680, but I haven't checked my credit for 2 years or whatever. And we will ask our clients to go out there. There's so many free resources to go out there and get your score, to go out there and find out what your score is. Because if you go in and talk to a banker and you don't know what your credit score is, you're automatically going to give them a bad impression right off the bat. I know we had all talked about this. A banker sizing you up within 5 minutes to see whether a deal is going to get done. If you can't tell how much your personal credit is, then that's going to be a big roadblock there. I actually had a client I was just speaking to just a couple days ago, and there is bad things happen to good people. This particular person had a divorce and wrecked their credit, and so we're going to work with that, try to get them to where they need to be, 680 and above. I saw many comments about which one you use, but generally which credit bureau, but you really need to be at 680 and above. The higher, obviously, the better. And then in this gentleman's situation, we asked, let's write a letter of explanation. What happened? Let's find a lender who understands that part of the credit, wasn't entirely this person's fault for that credit score.
That's helpful. And just kind of looking at the chat, Patty, I think you did a good job of giving the overview of the programs. Again, there are different programs at state levels. There are conventional programs, right? Like SBA is an option. It's not the only option here. And I think the nice thing about, Craig, your point on the 5 C's is that from a lending perspective, those are foundational, that again, there's some variation on it. Every institution, every lender has their own appetite. They have their own business model. They have their own focus area. So, it's good to spread that out, try to do some research on options, but also to not limit yourself to a specific program. And Liz, I saw your question here, so I want to take that now. The way our guarantee works is we protect the bank, right? Or we protect the lender in this case. If we have a 75% guarantee, which is our flagship, and if we have 50% on, say, the Express program, we cover their downside loss. Ultimately, the business themselves, the business owner, personal guarantors, they're 100% on involved in the loan, liable for loan, guaranteeing the loan. The guarantee goes to the lender that helps facilitate the flow of capital. And I did see some other comments in there about uncertainty, and anytime there's uncertainty in the market, that can cause tightening. And in that case, that's also where we the SBA come in, is that we help as a counterbalance to that, to help expand and increase, so to speak, the aperture for credit, so the more credit can flow to businesses. I do want to talk a little bit now and transition more into the lender readiness piece, the types of financing. We touched on the products, but I think it's also, as a small business owner or somebody preparing to get a loan, you're not saying I need this specific loan. It's more or less my business is growing. And I think that for me is one of the areas of disconnect between the initial applicant and the lending process, is that The loans are, in my opinion, are there to help businesses grow, and that can be, it's not necessarily the proof of concept phase. So I've seen some pieces about bootstrapping your business, and the lender wanting to have more years of experience, more time and experience. That's one lender's appetite. Some people might want more experience, and this is why it's good to spread it around. But Patty, I think staying on that vein, maybe dive a little bit deeper into the types of requests and some of your interactions with businesses, in your years of experience.
Sure. So when you start talking about uses of funds, so you're asking a lender for a money to do what? And you're going to explain this in your business plan, regardless of what kind of funding you're looking at. A lender will probably ask you for your business plan, and that's going to outline what you're going to use the funds for. And then recognize once again that as there are different types of funding at different amounts, there are different types of funding based on your use of funds. So if you're planning on purchasing equipment or real estate, you're going to look at term financing. And so that's very similar to a mortgage, where you'll do a monthly payment, and the term on that loan will go anywhere from 10 to 25 years, depending on what you're purchasing with those funds. So you have a choice of term financing, or you have a choice of working capital financing, which would be where you're using those funds for your immediate cash needs to help you manage your cash gaps. Depending on your use of funds, it'll dictate what kind of funding you get, whether you're getting term financing or whether you're getting working capital financing. And they're not mutually exclusive. So it's very possible to get a loan to purchase real estate and then a second loan to help you manage your working capital needs. It all just depends on your use of funds within your business plan. And when you're writing that business plan and you're putting your projections together, you want to demonstrate a reasonable assurance of repayment. That's the first thing a lender is going to look for. They want to make sure that you are able to service the debt based on your projected activities. So use of funds, it can either be term financing or it might be working capital. And of course, it'll be outlined in your business plan.
Great, thank you, Vince. Staying on that vein.
I think it's really interesting when you look at companies, and at the SBDC, we have so many variety of companies that come through our doors. And I think most people equate the SBDC to startups, but the reality is 80% of our clients have been with us over 3 years or more. So once they're with us, they're with us. So we see pretty much every evolution of client that comes through the door, especially when you're talking startup. You tend to see more term financing, usually a 7A. And I will say the majority of people that are probably on this webinar today, your first loan is probably going to be an SBA loan. You do not have the established history typically. So this actually is a really informative, but you'll see startups usually with a term loan. And I would say one thing too is working capital. In addition to that, either it'd be in a line of credit, express line, depending on which business. And then, as a company matures, you may see more equipment purchases for expansion. There's so many different uses out there. That it just depends on the growth cycle. And then one thing that I was kind of thinking about as a company kind of matures, one thing they don't think about is, people, staffing when they're looking to exit the business. Working capital becomes more important for staffing and making sure that it's a well-run company. So those are some of the things that we see. There's so many different products out there. I would say one of the biggest thing is my clients, if they come in, one of the things that we always stress to them is making sure that you find the right bank and the right banker within it. To Patty's point earlier that all the banks kind of do something special. And you may have a perfectly bankable loan, but you may be at the wrong institution or with the wrong lender.
Right. Perfect.
Well, you touched on something, Vince, that I was going to mention. It's to be aware of your relationship needs when you're approaching a bank, because there's really two simple ways. One is a real relationship, where you're trying to maybe get that banker on your bail team, to be a real advisor. And then there's the transactional one. And it helps to know, as a small business, which one you're actually looking for, because I think it helps you determine when you kind of court these banking relationships, what the right fit is for you. Because some of you are going to be transactional. You just want to get that loan, you have everything else kind of set up. And then some of you really kind of need that hand holding. You need somebody that's capable of kind of giving you some guidance, because you can really find, if you reach out in your community, that you can find some outstanding bankers that are really kind of, occupying that advisor role. And if that's what you need, then that's what you should be looking for in your banking relationship, for sure.
Yeah. And I'm keeping an eye on the Q&A, so I'm gonna be looking ahead a little bit, but I want to stay on topic while we're talking about lender readiness, and I've seen a couple questions on startups. So obviously, Vince, like the SBDC network is a great resource. We also have veterans business development centers as well as women's business development centers. So, and obviously for the VA crowd, the veteran side is a huge resource that's available.
Yes.
And as you mentioned, these counseling services aren't just for the first-time borrower or that initial piece. And Patty, you did a great job of outlining the various programs at SBA. And sometimes as a business, it's good to think about your growth plan, your business plan, and look to the road ahead. And that's where some of these other programs, specifically the working capital pieces, really come in that sort of middle phase of expansion. But I also want, so we got the SB, the small business development centers, the women's business development centers, and the veterans business development centers as options available to you. But I also want to point out, and Craig, you sit in our Arizona district office, that we do have 68 district offices around the country, and in every state. There are several questions in the Q&A now about the resources that are available on the ground in a particular state. I'm not familiar with all of them, certainly, but I do think that the district offices are a great conduit to all of the various local and state, as well as the federal services, in the Office of Manufacturing and Trade, where Patty and I are part of. That's a resource you as well. And ultimately, I would file this under my no wrong door analogy, which gets used a lot in government, but even if you're reaching out and it's it isn't the right person, right? You were to call me about a microloan. I don't particularly handle microloans. We want to try and connect you with the right resources, and the district offices are great conduits, as well as, the SBDC. We work closely, with them as well. So, all right. Dovetailing fully into SBA assistance, and Vince, as the SBDC representative on the call, I'm going to throw this to you. I think let's do a deeper dive into the resources that are available, and then we'll move into the Q&A. We'll actually move on to Mark Williams, and then into the Q&A section.
Okay. So what exactly would you like to know? I know I've been watching the chat too, and a lot of them say, yeah, I've had a hard time finding the right lender, right bank. I know, Dan, and you guys all, your SBDCs, your SCORE, the SBA, your local SBA offices. I think looking at the top 5, your top lenders on the SBA list is a great place to start. If there may be a combination of national lenders, local lenders, but those are ways that you can kind of go in and, when you're out there, interview the bank and see if they even like what you're doing. And there's so many, to Patty's point earlier, all these banks like to do something different, but I may be getting a little off topic. Sorry, Dan, but I think it's so important for our clients to interview these banks. They're going to save themselves so much time if they do a little research up front, talk to the lenders, do they get what you're doing? You know, is this a right fit? You know, if you know it's probably going to be an SBA loan, ask the bank straight up and the lender, how many SBA loans did you fund last year? You and your bank, are you talking to the right person? I know there's so many resources out there, but I really like to really hammer that part home, because half your battle is finding the right bank and the right lender. So reach out to your SBDCs, reach out to SCORE chambers in your SBA offices, your chambers of commerce. I would hesitate to maybe peers in your industry, because it's so often, we've done a lot of breweries, and a bank's only going to do so many brewery loans. So what may work for one person in a bank is not going to work for the other, because they've done too many brewery loans. They don't. A bank wants to diversify their assets. So that would be my suggestion. I got a little off topic there, Dan. So
We are here to get off topic and have conversations about, you know, what's working and our own personal experiences. Craig, I'll pass it back to you.
Well, Vince, just to kind of follow up on that, I get this question all the time, right? Because it can be difficult. What I tell borrowers is really two things: is you should reach out to your local resources first for referrals, and then also use lender match, you know, and do both, because I prefer to have that conversation, right? I prefer to do that interview, but I'm comfortable with those questions. You may not be comfortable with what questions you need to ask, and for that, you're going to want to start with the resource partners, right? Whereas if you go to lender match and you go to our online path for you to be connected with a lender, you're kind of making that connection directly. And so I always recommend that a business do both. You know, go ahead and find that lender match through SBA.gov, and then also reach out to your local resource partners to get references or referrals to lenders that are active in your market. And you can go to SBA.gov. There's a little bar or tab up at the top where you can put in your zip code, and it will then spit out all of the local resources so that you can contact people in your area, because lending is regional. You know, your active lenders, Vince, are different than the active lenders in Patty's market and then where Dan's at too. And certainly Arizona is very different than all those markets. So lending is very regional and it's very specialized. And reaching out to your local resource partners that do this all the time, that match small businesses and lenders could be a vital assistance for you.
good advice, Craig.
All right, Patty, if you want to take us home as we get ready for Mark to come on.
Sure. So a couple of other resources that haven't been mentioned yet are excellent. If you're a manufacturer and you want to take a look at some of the resources that can help you within your state, you want to look into the Manufacturing Extension Partnership. And so each state has its own what's called MEP, Manufacturing Extension Partnership. They offer training, they offer supplier sourcing guidance, they offer consulting to help you become more effective in your manufacturing operations. So that's one area you can go to if you're a manufacturer in need of assistance. If you're an exporter, two of my most valuable partners are the U.S. Commercial Service, which can help you coordinate and do that very valuable market research to figure out which markets to go into. And on top of that, they can help you coordinate those face-to-face meetings with potential distributors or foreign buyers. And then a second very important partner for me is the U.S. Patent and Trademark Office. At least in the international realm, the U.S. Patent and Trademark Office has what's called the International Attaché Program. So if you're selling into Europe or you're selling into China or South America, they have experts in those markets to help guide you in terms of how to protect your intellectual property. So there's a specialist in Beijing who can help you deal with local laws to protect your intellectual property. So those are two of my strongest partners for exporters who are looking at either expanding or starting their exporting. So those are my three go-tos. I can certainly list off a whole bunch more if you want me to.
There's some others, and we touched on SCORE being another, one earlier in the call. So, and Mark, as we get ready to bring you on, I'll take one question out of the chat here, and then we do have more time. Christian had a question about why would we use an SBA product over conventional, and the answer is you wouldn't. So, if there's a conventional option, then that, you know, that meets your needs, then we think you should certainly go with that. We're agnostic on what programs are used. Ultimately, our programs exist to help businesses access capital, but we're not the only option for business capital. So again, there could be conventional solutions. There could be supply chain finance programs. I mean, there's a lot of different solutions out there. The SBA is a common one, again, with more than 80,000 loans supported last year, but it's not the only one. So this is why I think when you're meeting with a lender, have that conversation about your need, your business, where it's going, where you've been, and then let them kind of steer you and give some options, because there could be some great options that we're not even talking about here today. So Mark, if you want to come on, this will kind of close out the presentation side, and then we'll get into the Q&A.
All right, thanks, Dan. Can you hear me? Am I good? My audio is
Clear.
All right, giddy up. So great panel. Can't really say anything better than what they've said. Did want to say a couple of resources in addition to those. I'm the director of SBA's Veteran Business Outreach Center program, which is 31 centers which are strictly focused on helping veteran small businesses. That's their sole responsibility. Wherever you are in the country, there's a VBOC that covers you. It's a great starting point. What's good is, I see a lot of things. Oh, how do I do this? Who should I talk to about that? It gets confusing. You've seen, I don't know how many resources during this thing. It's all great. What the VBOC can do is be sort of the traffic direction for you. So, okay, well, this is what you need. This is the resource to get that. We're happy. We don't really care if we're the one who helps you. We have SCORE, we have small business, we have women's centers, we have Apex accelerators, we have local community development. We have all these resources. We're going to connect you to that. So I think the VBOC is a great place to go. And if you click the link I just put in, www.sba.gov/VBOC, wow, that was quick. You'll find which one of those resources are closest to you. I'll drop my email into the chat as well, which is tough because I'm trying to multitask. One of the things I did want to say that's important here is sometimes you're not quite ready to get that loan. Sometimes you need another program to get you there. You might need training, you might need whatever. One of the other things our office does is we have a program called the Boots to Business program, which is beginning entrepreneurship. What's being an entrepreneur all about? What are some of the resources? One of the good things is if you take one of our Boots to Business classes, we have classes for transitioning service members. We have classes for people who are already transitioned. We have classes that are specifically targeted to military spouses. If you take one of those classes, you become eligible for a program called the Boots to Business Revenue Readiness course, which is a 6-week follow-on course, very high touch. When you come out of that, you've got, some really good market research, which is one of the things you'll need, and also you'll be close to a business plan. So do that. And then Craig talked about the SBA district offices. There's a thing called the Veterans Business Development Officer. Craig is one of those. So each one of our offices has one of those. Patty talked a little bit, and we're talking about the Made in America program, which is reaching out to manufacturers, businesses that are manufacturers. So if you, if that's your business, we've got additional resources to help you. That's an area of interest for this administration. So if that's your jam, we got things to help you do that. And then I guess I would just say, one of the things that people have kind of alluded to, business is local. So you can get on here with all of us people who are kind of national, but the best thing to do is to reach the Patties, to reach the Craigs, to reach Vince, the people who are in your community. They're going to know what's the best resource, who to connect you up with, who to hook you up with. So don't be afraid to reach your local person. Last finance thing I want to talk about, and I'll shut up, is there is a program called the Military Reservists Economic Injury Disaster Loan. It's kind of a not well publicized SBA resource, but if you're a reservist who owns a business and something happens to you or a key person in your company, you get sent downrange and your company is going to struggle because you're gone, there's an economic disaster injury loan that might be helpful to you. And I think I'll turn it back over to Dan. That was
Sure.
a lot, Dan.
Mark, you covered a lot of ground. That's why we're recording this. So now we're going to move into the Q&A section. So I will, again, for the panelists, Craig, Vince, and Patty, feel free to take a look. Feel free to ask each other questions. I will get it going. I'm paraphrasing a couple questions here, but there's a question about having a good credit score, having money to invest in a business, and a loan and a lender not making an investment. Like I do think it's important to approach this. It is a loan; it's not a capital investment. Right. And it gets back to the cash flow analysis that we've touched on, Craig, and earlier on the 5 C's of credit. It's not so much about making a loan, it's about getting the money back. So why is cash flow important? Why is 12 or 24 months or more of operating history important? Because the lender is taking a look at your performance in 2024, your performance in 2023, seeing was there enough cash flow to repay this loan, whatever that payment is per month. And why startup lending is tricky is because inherently there is not an operating history, right? And banks are there, generally speaking, lenders come in to fund growth, not to invest, because you're not giving up ownership. And there was a comment as well in the Q&A about the rate environment. Yeah, we're in a higher rate environment. We have been in one for a couple of years now. And for a long time in the 2010s, the Fed funds rate was at 0 and prime was 3.25. And rates, were in the mid 5s and 6s, and now they're north of 11 in some cases. And obviously that strains cash flow. So I do think, obviously, as you build your business, as you prove the concept, when the concept is proven, I think that's a good spot to get financing. But then just being mindful that building your balance sheet, building your cash flow is really important, because we're in a higher rate environment today than we were a couple of years ago. And that's going to strain your cash flow. And ultimately you have to have those reserves. But being that lender borrower relationship is different. It's not an investor. It's not friends and family. It's not your own personal capital. And that's a piece of it. So obviously I covered a lot of ground there, so I'm just going to offer it to the floor for any additional comments on that.
I'll jump in on this. As far as we've heard a couple comments about, Dan, you said about historical financials information. The other one, I think someone said, well, experience. The banks are looking for experience. I know that one thing I'd like to throw it out there for our client, for the veterans out there, is how about maybe looking at a franchise where you do have some historical. It may not be in your market at this point, but we work with a lot of franchises, and we're able to pull data from similar markets, and it mitigates. There's a turnkey operation, there's historical information, there's an ability to come in there and get trained right away, and it offsets that. I will say banks really like franchise lending a lot, and it might be a way to mitigate some of those potential weaknesses. The other part, I think, earlier I wanted to add in on SBA lending. One of the biggest advantage, in my opinion, you guys can weigh in, but the amortizations that are allowed in SBA lending. I have clients who choose SBA lending as opposed to conventional because of the amortization schedules that they would get with the SBA as opposed to a conventional deal. But those are just some kind of a couple things that I've seen. So
Great. I did see a question. I'm going to take two of them here. Barbara, you had one about debt consolidation. In general, SBA loans can allow you to consolidate debt, and Vince, that's probably a play on your amortization. So amortization being the time it takes to repay, and in general, the SBA would be very broad strokes plus 5 years on a conventional loan. So a lot of conventional equipment financing might be 5 years. SBA can support 10. Real estate, SBA can go up to 25, where a lot of conventional is 20. Now, a couple things on debt consolidation. You can't be in a position, it can't be bad debt. You can't be behind on the debt. It has to be current. And ultimately, we mentioned lender match. The SBA lender match system is a means to, as you get an application together, if you're working with SBDC or SCORE or VBOC, the different counseling groups here at SBA, it can take that application and put it out to market with many different lenders. And that is a good way of not having your eggs in one basket and spreading it out across, the SBA lending space. And this is where I also want to have some input from the group. Shannon, you had a question about the bail team, and that is a good piece that we should cover in future presentations. So bail is banker, accountant, insurance, and lawyer. Basically the professional industry, so to speak, that would surround a business. So banker, call that lender. We've touched on that. Accountants, I think, is an incredibly important piece. And maybe if Wendy, if you'll have us back for another presentation, we can get into more of those mid-sized loans where the accounting becomes really important. But and Craig, I know you touched on this earlier about making that first good impression. I would say having your financial statement in order, having your projections in order is probably the most important thing. If I could say one takeaway, having your books right is probably the single thing you could do to improve your chance of getting a loan. And then you obviously got insurance that can take, call it your property and casualty. Also on the international side, there's some additional products, and then lawyer, because of course there has to be a lawyer involved. Not only are you negotiating loan documents, but Patty, Vince, Craig, just maybe a little bit of the importance of the professional network. And I know, Patty, we work a lot with logistics as well. You touched on that earlier. But I think having a good bail team or just good network of professionals, and I think that also extends to the counselors and some of the state, federal, and local resources available, but maybe share some best practices or some interactions as we close out the webinar here.
So I'll start out. So certainly all the above. One of the things I've helped some small businesses do is put together their advisory board that includes this bail team. So it'll not only be other small business owners who are in the same industry, but it'll be experts in these things you don't quite know how to do or don't quite know all the ins and outs of a particular, like moving product from the Port of Houston to a port overseas in Europe, or understanding the impact of tariffs. So who are you going to call to help you put these calculations into place so you understand how that's going to impact you and your landed cost, or the full cost you should charge your buyer in order to be able to cover all your expenses. So certainly when you're putting together your advisory board, start looking at those particular pieces of the puzzle that you don't have a full understanding of. Start picking a subject matter expert. And typically within each state, there's an ecosystem in there to help you find those subject matter experts.
Thanks, Craig.
I would probably take all day if I went into great detail, but I'll just talk about lending contracts, because when I train borrowers, it's always explaining it this way. A lending contract is like getting into a marriage. It could be a 5-year contract, a 10-year contract, a 25-year contract. So just make sure you completely understand what you're signing. There are a lot of ways that these things can be structured, and a lot of times we'll say, well, it's either fixed or variable, and it's got a term, right? But lines of credit are structured differently. Term loans are structured differently. And if you have a variable rate note structure and you don't really quite understand how does that function of variability work, you should really read that contract, or get a third party, a lender, or somebody that's a resource partner that knows how this stuff works, read it to you. Because we talked about interest rate environments. We talked about the fact that rates have gone up quite a bit. A couple of years ago, while that was happening, I got call after call after call from borrowers saying, my payment went up. I didn't know this was going to happen. Versus the borrowers that did know that it was going to happen and prepared for it, because they know their note was variable, they know what it was tied to, they know what the margin was and the index was, and they could even tell you what the payment was going to be before it actually happened. And so it's just important that you understand, in line with that bail kind of idea, that you really understand the contracts you're getting into, because many of these contracts are very long term.
Vince, if you want to close this out, and then I will add my 2 cents. So we'll ask Wendy for an invite back here in a few weeks.
Craig, that's great advice. Patty, you guys really nailed it. Dan, I'll go back and I'll be right behind you. As far as having a fully vetted financial package going into a lender is probably the second most important thing. Once you find that banker, time is money to a banker. When you have a $15 million loan goal, you're trying to make $15 million in loans, and are they going to give you the time of day when you don't have a package that's ready to go? No, you're going to go to the end of the line. So coming in, making sure you make that really solid first impression will get you a long ways.
Absolutely. And, as we wrap up, I really want to thank everybody for, again, joining us here today. We had a lot of questions that we're trying to cover as many as we can. I'm only looking at the Q&A. I can't keep up with that chat, but we will respond to Q&A questions that we didn't cover. Earlier I touched on the volume of loans, right? 82,000 across all these products. And it's not to say, look at how many loans there are. It's to say that these programs have been around in various stages for more than 70 years. The SBA was founded in 1953. So through a variety of economic conditions, through a variety of rate environments, these programs have remained in place. And, whether that's COVID, whether that's the financial crisis, yes, I think the biggest piece of SBA lending is they're boring, right? They're available. They don't change a lot, which is good because they're sort of a bedrock for small businesses who are accessing capital. You don't have to worry about program features changing year to year to year. We're trying to refine them. We might launch new programs. But in general, the 7A, the 504, the Express program, our microloan program, these have been around for decades and haven't changed. Yes, the rate environment might change, the business climate might change, but the programs, at the end of the day, they're loans. They're repaid over, generally 10 or 20 or 25 years. You can count on that, and that the fact that there are 2,000 lenders that offer these products in various combinations means they're available. So look at your local resources, connect with your district office. Check out Lender Match if you're going to market. It could be a great way to test the waters. And, again, reach out. We're here. There is no wrong door. Thank you very much, Wendy. Thanks for having us. And thank you to my panelists as well. So take care.
Thank you.
Thank you, everyone. I do want to say that the recording will be available in 2 days. So you will receive an email along with the panelist information. And before you guys drop, I do want to thank the panelists for coming out and to speak today. Although it's Financial Literacy Month, being financially aware is a year-long practice. And your participation and engagement in discussing the key takeaways regarding the small business loans were immensely valuable. And together, we are continuing to empower our businesses to make informed financial decisions. To the participants, thank you for your commitment to learning and growing. And please, everyone, enjoy the rest of your day.
Thank you.
Thank you.